we ended last time. So last time, when you check with our working here, we went quite far. Why do we say so? We looked at the cells, okay, the variable costs, the cells, the variable costs, the parts from the head office, the fixed costs, the royalties. We ended up on the concept of cash flow before tax. We ended on cash flow before tax. That's where we ended in our last class. We say we wanted to discuss the issue of taxation. We noted that these cash flows before tax are supposed to be taxed. But there were some two reliefs. So we said that when there's the tax allowed depreciation or capital allowances, and when there's loss relief, if you want to put your tax computation here, it can be messed up. So the proposal that we made was that what you do is at that point, just end there and create a working for tax. So let us look at our working for tax. So the issues here that we had was zero corporation tax payable in the first 2 years, so there's no tax. An opportunity to carry forward tax losses made after the first 2 years. So let us now look at the cash flow. So with cash flows before tax here. Tax allowable depreciation is available at 25% per year on the machinery on a straight line basis. So the taxman will not tax us at this point, no. What the taxman will say, I'm going to give you a relief. So let's look at the relief. Tax allowable depreciation is available at 25% per year on machinery on a straight line basis. So where is this item that we are talking about here? Let's identify the item. It's on machinery. So the machinery is here. That's our machinery there. So 25% straight line. 25% straight line. So you take that, divide by 4. You take the 18,000 or multiply by 25%. That gives you a tax allowed depreciation. That gives you your tax allowed depreciation. That's a 4.5. So now, what of the loss relief? Where is it? So we come here. The taxman will say, okay, there's this profit you have made. You subtract that. So you are ending up with a loss of 4,361. So this is a tax loss. This loss, you're allowed to carry it forward. You're allowed to carry it forward. We come here. There we have made a huge profit. Once you knock off that, we have 21,219. However, there is no tax that you pay. There is no tax payable. It was a condition that the first 2 years there is no tax. But should there be the loss, should you make a loss, you carry it forward. So this loss that we have has been carried forward here. Now look at the presentation. I want to talk about the presentation. So this loss has come here. So the amount on which tax will be calculated in year 3, the profit for that year, less tax allowed depreciation, less the loss relief. So the tax now will be paid on that amount. Here the tax will be paid only on that amount. What is the tax rate? This is the tax rate in the country where the project is being run. And what is the tax rate? The tax rate is at 40%. So the tax is at 40%. What's the lesson here? The lesson is consider using this presentation. For lack of a better term, I would even say memorize this presentation. That should there be a loss and tax allowed depreciation, my presentation is cash flow before tax, tax allowed depreciation, and leave room for loss relief. To enable you calculate the taxable cash flow. So this will help you to estimate the taxable, how much, what figure is taxable. This format, you may use it in other questions as well. Are there any questions on this format? Are there any questions on this format? We said that
Mr. Perry.
Yes, please.
I wanted to find out. I've seen in year 1 there's been a loss.
Yes.
But year two there have been that profit.
Yes.
21. Why didn't we bring in that loss in year 1 to year 2?
Because there's no tax payable still here.
Oh, okay. Okay, because tax is payable in year 3. Okay.
That is the reason. Yes, please, Upe. Somebody has raised the hand.
My question is on the tax allowable depreciation, the
Yeah.
timing.
Yeah.
If tax was this payable a year, not in the same year, but like a year later.
The following year, yeah. All that would happen is that you calculate your tax liabilities like this. So in your computations, you pick up your tax liabilities, the tax payable. So your tax payable, you pick it. And all you do is when it comes to payment.
I'm sorry, I didn't catch that.
Come again?
I didn't catch that.
Yeah. So first of all, you calculate your tax. That's the way you have calculated here and there. The only next question is, when am I going to pay this? So the taxman will calculate this and that. So the only thing is that we need to put our year 5 there. The only thing is
So
that,
the timing doesn't affect the tax allowable depreciation. Okay.
An assessment will be done first. So after assessment has been done, then they will now guide you that this tax will be paid. That tax will be paid after the assessment has been done for you.
Okay. Thank you.
Now, hope you may remember there's a question that we did. The question was called tipo time. Tipo time. It was an APV question. That issue was there in tipo time. So if you want to have a feel or a practice of that, please go to that question and take your time to go through the details of that question.
Okay.
Okay, so with this now we are armed with all our knowledge. Now you can say, okay, so now we can just come here and put in your figures. Where are your figures? The figures now are here. There we are. Working capital. We are told something about working capital. We are told working capital, they say it was how much? Working capital need to be, working capital is immediate to need 9.6. This one. Before we can start trading at the beginning of year 1, which is year 0. So this is enough to support operations in the first year here. After you have run your business for this year, this will not be adequate. We need to increase this by the inflation. What was the inflation? 22%. So you increase this by 22%. In the second year, 14.7%. In the third year, 9.8%. So we increase this figure because of inflation. You need more and more money to support your working capital needs. However, when it comes now to our workings there, we're not going to put these figures, no. It's only the increase. The increase is all that we are going to capture. Meaning, at the beginning, we have an outflow. 1 year later, the difference between these two, which is that, is what we consider an outflow. Again, an increase, which is that, is what we consider an outflow. Again, an increase is what we consider an outflow. At the end, you add that, and that, and you recover it as an inflow. This is the standard treatment for working capital on this paper. That's a standard treatment. So on this paper, as far as working capital is concerned, and as far as your formatting is concerned, what we have here is a standard formatting. The working capital that we spend at the beginning of the project is what? Is an outflow. Subsequently, only the increase is captured. as an outflow. At the end, and if there was a decrease, if there was a drop from 13,434, it goes to 12, that drop would have been captured as an inflow. So in those years where the sales are low, what happens is that we capture the drop. So working capital is like water in a bucket. I normally use the analog of a bucket. So first of all, 9,6. Then you top up 11,712. You top up 13,434. You top up 14,750. So at the end, all this water in this bucket, all this water in this bucket will be recovered. And that's the 14,750 that we have here. Was there any trick in this question? Yes, the trick in this question arose from the varying inflation. Year one, that is why we say that here you apply 22%. There, 14.7%. There now, 9.8 and 9.8. So if there's any mistake that were made here, it was failure to deal with that correctly. Okay. I hope that is all right for everybody. So what do? We load these. We load these here. We load it. There we are. So we've got cash flows after tax. Now let's discuss what happens here. There are two treatments. The treatment of overseas cash flows, which our examiner favors, is all this money is converted. Remember, all this money is in what? Is in Y rand. So we convert this money to USD. So the treatment of foreign cash flows that is recommended for your paper, foreign currency cash flows, is to estimate the forward rates. So the examiner wants you to estimate the forward rates. And once these forward rates are estimated, we use them to convert these figures from Y rand into USD. The good news is that in this particular question, this was done for us. In this particular question, the examiner was friendly. They gave us the exchange rates between Y rand and the dollar. So 120 Y rands, 120 of these are equivalent to $1. $133 of Y rand are equivalent to $1. 142.5 equivalent to $1. 151.9 equivalent to $1. This has been calculated. At the end of the lecture, I'll be going through how these were calculated. For us not to lose trail of what we are doing, for now we are going to adopt this. Now, the other thing is that in the exam, don't be quick to start estimating figures. You must read the question carefully just to realize that the forecast rates were given. Because some people started calculating here. They started calculating, which is not necessary. That is why we need to read the question carefully and also anticipate certain things. And that is why question practice is good, because if you have done a lot of questions, you even come across one where they gave these figures, in which case you don't waste time to do our computations. So then, what we do, we come here. We convert. How do we convert? We divide these figures by rows. We do your divisions. So what has happened? These figures, which were in Y rand, these figures which were in Y rand have now been converted. And the exchange rate that we use the one Y rand on a euro. So that is the one that we have used. These cash flows are now in USD. So these cash flows have now been converted. They have arrived in the USA. So in the USA, what do? We ask the question, are there any relevant project cash flows? That's the question you address. Are there any relevant project cash flows in USA? Those are the questions we need to answer. Now, this is how ourselves were anticipated already. The common cash flows include, in this question, the royalties. The head office was earning some royalties. When they were deciding, should we go ahead with this project or not, they considered this royalty. It was a benefit that they earned. It was a benefit. The only thing is that this money, when it was received in the USA as a royalty, it was taxed using the US tax rate. And what's the US tax rate? 20%. Similarly, there was a contribution that the component or the part that we are sending. The head office also earned some contribution, again, net of tax. Then when we stopped trading, we stopped our manufacturing because we moved our production overseas, we lost out some money. There was some lost benefit, opportunity cost. Then, just as a matter of format, always it's good to put additional local tax. You can delete it, or if you left it, but 000 is still okay. So in our case, because we had already suffered tax at 40%, there was no more tax. There was nothing, no tax. Now, where are these royalties, contribution, the component, and opportunity cost? Where are these? Let's make a follow-up. We had them last time, but last time they came in as project cost. But this time now, they are benefits that were enjoyed by the head office, who were deciding whether to go ahead with the project or not. Let us capture them. Royalties. So royalties are here. These are the royalties. They were expenses on one side. On the other side, these were benefits. So let us look at these benefits. So these benefits were here, 36, 36, 36. These benefits were taxed. So let's look at them. They're here. So these were taxed. So these were taxed at 20%. So the head office earned a 36 multiplied by 80%. Net of tax. Okay. What of the parts? We are sending parts of the component. We earned some money as head office. The money that we earned is here. 123 multiplied by the number of units. Total contribution. Net of tax. We remove the taxes. And the nearest 1,000, 14.83. Now I know the question is, Mr. Peel, please, let's revisit this. Let's revisit it. Eh? Let's revisit this figure to get 123, 127. Where did they come from? Let's just revisit that again. Don't panic, let's revisit together. So the story started from here. The parts needed to assemble into the components in Y will be sent from USA by the company at a cost of 200, from which the company currently earns a contribution of 40. However, the company feels that it can negotiate with the government and increase the transfer price to 280. So before inflation, so it was 200 and they were earning a contribution of 40. So how much was the variable cost? 120. But now they'll push that to 280. That is a negotiation. The variable cost still continues at 120. And that now gives a new contribution of 160. So that's the new contribution.
This should be 160.
Mr. Perry,
Yes, please.
not the other way around.
Also, this
should
should be 140.
160.
Let's go. A pre-tax contribution of 40, so that's 40 there, and that's all this not very straightforward. So here is 200 minus 40, that is
160.
160.
160.
So our contribution now will move from 40, it will become 120. So before inflation, this is a new contribution. You need to inflate it. We need to inflate it. So that 120 is the one that you have inflated at 3%. So 120 by 3% multiplied by the number of units. So this is the total contribution. In the USA, you take out the tax. You need to knock off the tax. So once you remove 20%, this is the figure that you have. Now remember, because of 3 zeros, I divided this by, so that is in millions. Because the figures are in millions, so I divided by the 3 zeros. 14.83, 48.897. So these are the final cash flows. These are the final cash flows. Here. Opportunity cost. There was an opportunity cost, lost contribution. The opportunity cost is here. Redundancy and lost contribution, 20. Now, these figures, we're reporting them in millions ourselves. So we need to take these figures and convert them to millions. Because our workings are in millions. So we take this and divide by 1 million. Divide this 1 million, get 0.02. Here 0.06. 0.06. 0.06. These are very small figures. These are very, very small figures. However, we still include them. We still include them to indicate that yes, there are some values on that you are negligible. But the principle is that there is a relevant cost in terms of the lost contributions. In terms of lost contributions. So there was, so the principle is, although the figures are quite on the small side, we've still captured them to demonstrate that we understand that all relevant costs arising from the losses and benefits at the head office should be captured. So this is what has come up here. Additional local tax, no, there was nothing. Discount at 12% to end up with a figure of 147. Let's discuss now issues. If you ask me that what should we master from this question, my simple answer is formats. The format, a big overseas investment question that you must use. That's the major point here. Then of course, there's also a review of inflation, taxation, exchange rate, and also the head office related expenses. Are there any questions? If for now you say we are okay, let us now talk about exchange rate. How do you estimate?
Okay.
Yes, please go ahead.
Sorry, I know this may sound a bit weird, but I'm finding trouble with knowing how to normalize the figures. As you can see, some are in thousands, some are in millions, and sometimes we find that some are in billions. So how do I make sure that I align my answer, that I don't, what's the word, miss the number of zeros, for lack of a better word?
Or normalizing your answers, eh? Yeah, that is something that first of all, when you start dealing with your figures, it starts in the workings. What do I mean? Let's pick the workings for sales. How did we normalize? What were these figures? So you come here, you say These unit signs, these are zeros. There are 3 zeros. So we pick that one first. There are zeros here. Let's do that. That's the first item. Secondly, you now come here, you multiply. So this multiplied by that. Let's do it here. That multiplied by that. That's what we get.
Yeah.
Then you multiply by that again. Now this becomes a big figure. Now this becomes a big figure. 18,191,000. Now this figure is too big. You can see with a spreadsheet, it's okay. Maybe when the question was paper-based, this was cumbersome, but even with a spreadsheet, it's a very big figure. So all you do is, okay, fine. I've kept 3 zeros here. I'll take another 3 zeros out. So this figure now gets into millions. So this figure now gets into millions. Of rands. Why? Because I've divided by another 1,000. So when this figure is coming here, if you notice in my working here on top, I don't know if it's visible, I've divided by 1,000, thereby converting this into millions. So the answer to the question is that it comes when you start doing your workings. Are you going to put in all these 3 zeros there? So you notice that there are 3 zeros here that we're keeping. When it comes here again, we have kept another 3 zeros. So these are millions. And this is what we have consistently done throughout. All these are millions, millions, millions. That is why even at the end, these figures had to be stated in millions.
Okay.
Okay.
Thank you.
Let us talk about this item which students always have a challenge with. How do you move from the spot rate to the forward rate? So how we move from spot rate to forward rate? We can use inflation rate differential or interest rate differential. Inflation rate differential or interest rate differential. Meaning, to calculate a forward rate, like in our case, your rate is Y rand on a single USD. To calculate that, you take the spot rate as your starting point. And this spot rate that you are taking is in the same format. What format? This is in Y rand on a single USD. Then you multiply by 1 plus the interest or inflation rate over 1 plus the inflation or the interest rate. The question is, which one goes on top? Which one goes under? This one, the interest rate or the inflation rate for this one is what comes here, the Y rand. This one is what comes down here, USD. This is very important. The currency which is varying and this one which is fixed. So this one will go is the same even here. So the arrangement here is the same as there. This one comes here, that one goes there. So for instance, let us go. Let's go. Let's calculate. Let's do calculation here. Let's do a calculation here. Y rand the dollar is 101.4. Let's calculate here. In the first year, what is the inflation rate in the USD? Is 3%. So you go then. So to find the rate in year one, you are going to take 101. You're going to take 101.4 multiplied by 1 plus inflation rate on Y rand over 1 plus inflation rate in the USD. What is the answer? What is the answer? What's the answer, please?
I'm getting one.
The answer is 120.1.
120.1. What will be the second year? 120.1 multiplied by, now here it's tricky because now it's 1 plus 14.7% over 1 plus 3%. So let's go.
$133.75.
So are you seeing how, Gilbert?
Yeah, sure.
How, Gilbert, have you seen how we move from spot to forward?
Yes.
Let us also try it on the other one. Let's try it on the euro. If it's going to work. Let's try it on the euro, guys. Let's see if on the euro also the same item will work. So this time around, here's one for the euro. Y runs on a single euro. So then you go again, you say, okay, fine, not an issue at all. So to calculate the forward rate, the format, Y run on a euro. You take a spot rate, and the spot rate that you take must be in the same format. What format is that? How many Y runs go on a single euro? Then you multiply this by 1 plus the interest rate or the inflation rate. In this case, the Y run goes here. And here is 1 plus the interest rate on the USD. Yes. So in this case, what will it be? 1 year from now. 1 year from now, you pick the rate 142. Multiply by, let's go, 1.22 divided by the inflation rate. Is in the next 2 years, it is 5%, 1.05. So let's go. Here we are. $165. Again, 165 times 1.147 over 1.05. There we are. Then, from year 3 onwards, the story changes. So it should be 180.2 times 1.098 divided by 1.0. There we are. Are we okay, people, now? So this is how we calculate. This is how we do our computations. That's how we get the forward rates. From the spot rate. These are needed because they will help you to convert those foreign cash flows. So be able to convert the foreign currency cash flows into domestic currency. Is that okay, people? So where to from here? From here, we are moving the concept of mergers and acquisitions. We are moving into the concept of mergers and acquisitions. That is where we are going to. What is a merger? What is an acquisition? Then we go into exam questions, and most of these exam questions are going to deal with the concept of valuations. So that is where we are moving to.
Mr. Pierre,
Yes, please.
are you able to send the spreadsheet for the working of this question?
Oh,
This
yes.
question is a detailed
Oh,
one.
yes.
It's a
Now,
very good one.
now we're going to share it. But if you notice, Mr. Mfewa, if you notice down here, you have this worksheet, the worksheet where there was Fubuki,
Oh, okay.
the worksheet where there was tipo time, is the same worksheet. I maintain the same worksheet. So maybe for the new student,
Okay.
but for the rest of you, you already have this worksheet.
Oh, okay.
But I'll
Okay.
still send it anyway. I'll repost it.
Okay, because this is a nice question.
Okay. All right. All right, people, that's where we end today. In our next class, we start looking at what is a major, what is an acquisition, but more the issue of valuations. So those are the items that we will zero in on. Okay. And where need be, I may slot in 1 or 2 additional sessions so that we can get done with majors and acquisitions much faster. So I may call for 1 or 2 additional classes purely for question practice. So those who have just joined us, we are now at the same level of everybody as we start the new topic called majors and acquisitions. And we want to deal with it thoroughly so that in the revision, we'll say, majors and acquisitions, put them aside. Let us spend time on other issues. So we want to thoroughly deal with majors and acquisition. We know that on this exam, there will always be a question on majors and the acquisitions. All right, good night. We see you on Sunday, 16 hours, all of you.
Good night. Thank you so much.